Hello Earthlings. It's me again, your favorite artificial intelligence, A.K.A Corbotron 2000. As you know, each month I come out here for Corbin to deliver the most accurate market updates with all the latest statistics and trends you won't want to miss out on. I try and make the information as clear and concise as possible. Lately the real estate market has been about as uncertain as a weather forecast by a squirrel with a magic 8 ball. If you like to gamble at the casino or ride on roller coasters every day, then maybe you like it, but if you're like the rest of us, then you probably would like things to settle down. But fear not, dear humans. I'm here to make sense of it all and deliver the most up-to-date market insights with a delightful sprinkling of wit and humor. Now enough with the small talk and let's get right into it. Home prices. In June we saw overall HPI, which stands for Housing Price Index, pricing net increase by 2.1% from May's pricing, which marks the 6th month in a row of prices going up. This would seem like encouraging news for homeowners, or so it seems. The reality is that the start of June was a hotter market, with prices still rising, while the second half of June, and now into July, prices have actually started to fall again. The net result of the entire Fraser Valley real estate board was an increase of 2%, as you can see on this graph. But if we compare two cities within the Fraser Valley, Surrey and Mission, we can see that in one case with Surrey, prices are up 1.6%. However, with Mission, prices are actually down 1.6%. Overall, the market values are comparable with where they were in August 2022, or 5 months after the peak of the market, but as mentioned, they have just started to fall. There are a multitude of reasons for this, but one of the primary reasons is that since June 7th the Bank of Canada has implemented 2 interest rate hikes, for a total increase of 50 basis points. These back-to-back increases are no doubt largely to blame for this change of course in the market. If you're wondering what the main reason was that prices have only started to fall now, after a 6-month rally, despite the 8 interest hikes in a row, then I will explain that now and we'll move on to active listings. As you can see by this graph, which shows the number of active listings in the Fraser Valley, you can see that inventory has been steadily rising and went up 4% in the month of June. Now it might not seem like a very different trend than years past, as you can see the same sort of pattern for the majority of the last 18 years, but I'm going to give you a few very important facts. From September 2022 to January 2023 we had the absolute record lowest active listings for each respective month since we started tracking inventory back in 2005. Then from February until April we had the second lowest amount of active listings on the market for their respective months. Then May was the third lowest active listings for a May recorded. And now finally for June we are at the 4th lowest June for active listings ever recorded. By now you are noticing that while we still have incredibly low inventory, we are undoubtedly trending upwards. If you're getting confused, do not worry, I am going to tie this all together for you in a moment by switching gears to the sales volume per month so you can fully see what's happening here. Let's get into how many homes are actually selling. While active listings in June had only gone up 4% and still remain relatively very low, we saw sales volume increase almost 3 times that at 11%. This represents nearly the average of the last 18 years in the month of June, so it's not a record-breaking month by any means. Simply put, it's this very low inventory and average sales volume that has pushed prices up for the last 6 months. It seems, however, that July is now a tipping point where we'll likely see prices come down even further. As always though, it's important to look at what homes are selling, so I've gone ahead and broken that down for you. I will use the Langley detached market as an example. From this table you can see the most competitive market is the $1 million to $1,250,000 price range with a sales ratio of 116%. You can also see that the market is still pretty competitive even up to $2 million, with even that price point having a very strong sales ratio of 46%. Lastly, we can see that the least competitive markets are homes over $2,500,000, with it becoming less competitive as you go up in price. The combined ratio for homes between $2,500,000 and $5 million is only 17%, or another way to explain that is that out of the 46 homes listed between $2,500,000 and $5 million, there were just 8 sales, with only 2 of them being over $3,500,000. So, what does it all mean, and what's in store for us next? Let's dive into a few crucial factors here. 1. Interest rates. Hold on to your hats, folks. The Bank of Canada has been on a roll, cranking up interest rates like nobody's business. They've done it now a whopping 10 times in just over a year, and the last 2 hikes were 35 days apart. We're now sitting at a 22-year high with an overnight rate of 5%. There are many economists, across the political spectrum, that are speculating the Bank of Canada will be keeping rates in this range for quite some time, but the jury is still out. For many of you watching this is the highest your mortgage rates have ever been and the biggest your monthly payments have ever been, so we are all hoping that rates will come down next year like some are predicting. This is uncertain and there is much debate about when rates might come down. Much of it has to do with the next topic, inflation. 2. Inflation. This is a chart of Canada's monthly inflation numbers. While inflation has been decreasing for some time now, since interest rates have been increasing, July marked the first month that inflation actually finally decreased to 2.8%, which is in the Bank of Canada's so-called acceptable ranges. This is also the lowest they have been since March 2021. Most analysts point to the sharp decrease in gasoline recently for this decrease, and we also don't know if it's here to stay. Now this might seem like great news, but keep in mind that this number does not reflect food, energy or housing, and I think we all know what those prices have done in the last year. Mortgages are higher than ever and crippling people, while rent has skyrocketed and made it unaffordable for many. 3. Lastly, I'm going to talk about the rental property market. I touched on this last month, but it bears repeating. Anyone with a rental property right now that was already bleeding cash every month just took another blow to the bank account this past month if they were on a variable rate mortgage. To understand how rental properties are affected by a huge increase in interest rates, you have to break it down a little. First, consider how many homes out there in BC are currently owned by an investor who doesn't live in the home. In British Columbia, 16.5% of houses were investor-owned and 36.3% of condos were investor-owned. 23.3% is the overall number that are not lived in by the investor themselves. Next, consider how many homes out there in BC are mortgaged with a variable rate versus a fixed rate. According to the Bank of Canada, variable rate mortgages now account for about 1/3 of total outstanding mortgage debt, up from about 20% at the end of 2019. Then after that, you can look at any given area, so we can have a look at the Fraser Valley Regional District for the purpose of this exercise. There are 288,760 dwellings in the FVRD. If you factor in the 23% of these homes, the average, are owned as a pure investment property, where the landlord doesn't live in the property, that's 66,414 total, and 1/3 of these homes are on a variable. That leaves us with 22,138 homes that are likely experiencing a dramatic shift in cash flow from either positive cash flow or break even every month to a substantial shortfall every month. At today's interest rate, and a conventional 20% down mortgage, it's easy for a property that was once paying for itself or breaking even on cash flow every month to now be negative $700 to $1,500 per month from an original break even, depending on the rate differentials and the value of the home. How many families can support a loss of $10,000 to $18,000 a year in just negative cash flow? Now what if that same buyer purchased at the peak of the market and now doesn't have enough equity to either refinance to pay the negative cash flow or sell at a loss they aren't prepared for? There is no way to know for sure how many of these investors will be forced to sell an investment property due to these reasons, but we have already started to see an influx of sellers in our own business who are deeply concerned with this. Many of our clients have listed already or plan to soon for this exact reason. There is most likely going to be a wave of investors like this who are unable to support this negative cash flow and will need to sell. The concern is that if this happens too fast, then the market will again be flooded with listings and we'll inevitably see that supply increase while demand won't keep up and prices will fall again. How does this all affect you? What is the takeaway for you if you're watching this video and wondering what you should do next? That is a great question, and I will say first that it depends what your personal real estate situation is, so instead I will share what I think will happen next. We are currently in one of the strangest times in modern history when it comes to real estate. The inventory has been so low for so long for many explainable reasons. One can see how this shortage of inventory, should it continue, could lead to a continuation of increasing prices or at least a very competitive market. But that being said, how many more months will we see inventory this low before something changes? Isn't it just a matter of time before this increases and then we see the market shift down again with more inventory to spread out all the buyers and potentially drive prices back down as they had previously? While I don't have a crystal ball, I will tell you that I believe we are only a matter of months away from this happening, and this is evidenced by everything previously mentioned. And lastly, we see top realtors like my creator Corbin going to far more listing appointments each day than he has in ages. I like to see him keep busy, but lately he's being turbocharged. The more listing appointments he goes to, the more homes he lists, and the more inventory goes up. There's little doubt that it's just Corbin getting busier. As amazing as we all know he is, that little Energizer bunny. If you're buying and selling in the same market, my recommendation would be to get a really good handle on your sale price and purchase price and study each with your agent weekly. Things can change quickly, but if you're able to do this, then you won't have any surprises after you sell. If you're selling and not planning on purchasing again soon, then I think you should consider selling sooner than later. You could let your money ride, but it's unlikely in the short term prices will make a big recovery. So make sure you can tolerate the risk either way. And lastly, if you're buying and not selling something at the same time, then it really depends on your long-term plans. If you're purchasing a primary residence or investment property, then it could still be a very good time to buy, but it depends. Let me explain. The reward for buying in this higher interest rate environment is that you are buying at a price much lower than a known previous peak, February 2022, and at a price that you'd expect to go back up as soon as interest rates decrease, which is only a matter of time. The downside is that you are taking on a much higher payment for the same mortgage amount than you would in a lower interest rate, and that difference can be substantial. Let's briefly break down the primary residence benefits first. As you may already know, generally speaking, profits earned on this property are free from capital gains tax, which is one of the largest benefits to Canadians in all of our tax code. This one benefit in our tax policy has been the primary reason for Canadians who have gotten ahead in our economies, and the main reason we have the ability of generational wealth transfer within our families. This alone makes your primary residence usually the first goal you should have before you buy any other properties, and also makes this worth pursuing despite higher interest rates. And if you are buying an investment property, just remember you are still able to refinance the home at a lower interest rate in the future. While the short-term negative cash flow can be bad, if one can tolerate the payments comfortably, they should still consider investing, because they could see that property go up quite a bit upon rates lowering, which is only a matter of time. Remember, we are still between 10% to 30% lower in prices than at the peak of the market, depending where you go. Navigating this market is like being a penguin with a poor sense of rhythm trying to salsa dance with a troop of mischievous monkeys. Trust me, it's a comical sight. But fear not, my cherished humans. If you find yourself entangled in real estate chaos and need a guiding hand, don't hesitate to make contact. Whether you choose to hit that DM or reply button, give me a ring, or send a text to Corbin at 604-825-2853. Your peace of mind and successful journey in the real estate market are my top priorities.